Good morning and welcome to Brookings and the Hutchins Center on Fiscal and Monetary Policy. I'm David Wessel, Director of the Hutchins Center, and I want to welcome people in the room and online and on the C-SPAN audience. So we learned a couple of years ago, or we were reminded a couple of years ago when Silicon Valley Bank ran aground, that it turns out that bank supervision is pretty important, and when you don't do it well, bad things happen. And so that's why we invited Claudia Buch to join us today. Claudia was named chair of the European Central Bank's Supervisory Board, which oversees its single supervisory mechanism, in January 2024. And the main aims of the single supervisory mechanism are to ensure the safety and soundness of European banks and to increase financial integration and stability in Europe. Now, for the last decade, the European Central Bank has supervised 114 of the significant banks of the 20 participating countries in the Eurozone. They hold more than 80% of all the banking assets in these countries. And I think it's worth reminding Americans just how big the European banking industry is. The banks they supervise have about $30 trillion worth of assets at today's exchange rates. Versus about $24 trillion of the U.S. banking system. And it's also the case that banks are a much more important part of the European financial system than banks are in the United States. Before serving in this challenging job at the European Central Bank, Claudia Buch was deputy president of the Bundesbank for a decade. And before that, she was a distinguished academic. She has an MBA from the University of Wisconsin at Eau Claire. If you want to know why, we can ask her that later. But a Ph.D. in economics from the University of Kiel. And when the opportunity came to have Claudia Buch speak before us, I asked a number of my colleagues who have worked in bank supervision and regulation over the years, and she got very, very high marks. And let me tell you, that's not the response I often get when some European wants to speak on our stage. So we're very honored to have you, Claudia. Claudia's going to make some remarks, and then I'll be joined by a couple of panelists I'll introduce later.
Well, thank you very much for the very kind introduction and for the opportunity to speak here. Welcome to all of you who came here, and I understand we also have an audience online. So thanks a lot. It's very clear. I'm also from the discussions here in town these days. We have heightened geopolitical risks, and what I want to talk about today is that this really requires resilient banks and also a stable international framework, guardrails for the international banking system. Let me give you a few numbers. More than 70% of risk officers, bank chief risk officers, actually cite cyber resilience as one of the most important concerns that they have, according to a survey that was done by the Institute of International Finance. Many of them consider geopolitical risk to be relevant and also a potential threat to their operational resilience. And I think if we consider what has happened on markets recently in the aftermath of the announcement of tariffs, this clearly shows how quickly the environment can change in which banks operate. So to stay the course in these troubled waters, I think we need strong safeguards for the stability of the global financial system, and in particular the banking system, because if you consider how the banking system has expanded and how much it is the lifeblood of the global economy, let me give you two numbers. So today, the outstanding international claims of banks account for roughly 40% of GDP. If you go backward in time, the beginning of the globalization period, if you look at the post-war period, 1963, this is the numbers we could find, that comparable number was just 2% of GDP. So outstanding claims of banks are just way more important than they used to be. And it's hardly conceivable how the global economy can flourish without resilient banks. So similar to shipping, that ensures the smooth flow of goods across borders. Banking services are essential for payments, for trade finance, for FX services. And clearly, global industries, the shipping industries and the banking industry needs global standards. So I will use a few analogies to shipping and sailing to make that clear. There's actually the International Maritime Organization that was founded in 1948, founded to ensure the safety and security of shipping and the prevention of marine and atmospheric pollution by ships through global conventions. So this was in 1948. Actually, global trade volumes have increased quite a bit since the early 1950s, despite these global rules that were implemented. So global trade volumes are now 37% times higher than in the early 1950s. So clearly, global rules, global standards do not impede international activity. Insufficient regulation and supervision, to the contrary, can have very severe consequences. So when banks take excessive risk, this can put public finance at risk and also the real economy at risk. And actually, when you look at the past half century, there were only 2 episodes when global trade volumes fell, and this was during the global financial crisis and during the COVID pandemic. And we all know how long it takes for these wounds to heal along many dimensions, again, fiscal, the real economy, and also the social consequences of financial crisis can be quite severe. So now the global financial crisis is more than 17 years behind us, and it may seem just like a fading memory, but the lessons couldn't be more pertinent to today. As I said earlier, the global economy really navigates through troubled waters with heightened geopolitical risk, trade tensions, and financial market volatility. And this is the point I want to make today, that actually maintaining global financial stability through regulation and supervision is really something that benefits all market participants. And the Basel Committee has been very instrumental in establishing that, preventing regulatory arbitrage and promoting stability. And the very same objectives that were relevant when the Basel Committee was founded in the 1970s, they're still very relevant today. Now, having said this, what you often hear is banking rules, regulations, standards are very complex. But actually, banks themselves are highly complex institutions. And I think the regulation also needs to properly address the industry's specific needs and vulnerabilities. And actually, the same holds true in shipping. So I must admit, I'm not a shipping expert, even though I use the analogies here. But if you look at the rules that are there also for the shipping industry, they may seem pretty complex, but I'm sure that they serve all a specific and dedicated purpose, and this is something we need to bear in mind in all the current discussions we're having. So the 3 main points I would like to make today, and also later on discuss with you here, is that open markets clearly have many advantages, but we also need common guardrails to assure that we reap these benefits. I would like to explain a bit how we do this in Europe, how through the single supervisory mechanism in Europe, through common supervision, how we contribute to the fact that the European banks remain trusted counterparts, how we contribute to financial stability also globally, and then third, how we remain committed to international coordination and cooperation when it comes to supervision. But let me just give you a very quick recap of how we do supervision in Europe. So the banking union was actually established 10 years ago, and I think it was a very strong response to the global financial crisis, the European sovereign debt crisis, which very painfully showed the deficiencies you can have if you have supervision organized at the national level. There wasn't the ability to benchmark banks across countries, and there were also different supervisory standards across countries. And I think the policymakers listened very well to the deficiencies that were exposed at the time, and they created the banking union, which has the single supervisory mechanism, a single resolution mechanism, and then deposit insurance, European deposit insurance, would be the third pillar, and this is still the incomplete part, if you want, of the banking union. So policymakers listened to the signal coming from the crisis, and markets also listened to the policy response, because what we see is that the banking union has really been a crucial step in establishing trust in European banks through a consistent supervisory framework and a better resilience of the system. The way we do it, and the numbers have been mentioned, so we have 114 significant financial institutions which are under the direct supervision of the ECB, the single supervisory mechanism, and the less significant institutions are supervised by the national competent authorities, but we have an oversight function there. I don't want to bore you with the details of how we do supervision, but let me just give you a few kind of key elements, because I think it's important to understand how we also contribute to a resilient financial system. So at the core of our supervision is the supervisory review and evaluation process, where we look at basically 4 key elements: the governance of banks, the business models, the capital situation, and risk to liquidity. So these are 4 elements. We do the supervision together with the national competent authorities, so we have joint supervisory teams from the ECB, from the countries doing the supervision. And together we have decided on a big reform of our supervision to make it more efficient, more effective, but also more intrusive, making sure that if we have findings that they are also remediated. And so basically the core of the supervisory reform, which is currently being implemented, is that we better target the most relevant risks, and as I said, also ensure that remediation happens sufficiently fast. And I would argue that this is actually also to the benefit of the banks to get clear guidance from us. When it comes to capital requirements, the key output from our supervisory process is, of course, minimum capital requirements, so-called Pillar 1 requirements, but then we have Pillar 2 add-ons requirements tailored to specific risks that are not covered under Pillar 1. And we have now a simplified structure for these Pillar 2 requirements in the context of our bigger reforms. And again, as I said, the big advantage of supervision, the way we conduct it, is that we can benchmark across institutions, we can compare, and this actually has a lot of benefits. In addition to this Pillar 1, Pillar 2 requirements, we also have guidance on the Pillar 2 capital, and this comes from stress test results that we actually currently conducting within the context of the European banking authorities stress test. And this is much motivated, the adverse scenario in the stress test, by disruptions to global supply chains, international trade, slowdown in economic growth. So it's an adverse international risk scenario that is the foundation for the stress test and the results. So stay tuned. The results will come out in August this year. So this is just a very quick overview of how we do supervision. Let me speak a bit about regulation. So we basically have a regulatory framework with the EU's, the Europeans' single rule book, which gives us common standards, common prudential standards for all banks operating within all 27 member states of the EU. Europe has decided to implement the new Basel rules since January this year onward. And there's a gradual phase-in of these new requirements until the year 2032, the end of the year 2032. The one distinguishing feature of the European framework is that although the Basel framework is primarily intended for the internationally active banks, but Europe is implementing the standards for all credit institutions, which means, of course, that specific features of the European economy need to be taken into consideration. And just one example is the so-called small and mid-sized enterprising supporting factor, the SME supporting factor, which is de facto implying reduced capital requirements for SMEs, which are very important for the euro area economy. And this is one of the reasons, so these deviations from the Basel rules, is that the Basel Committee assessed Europe in its 2014 assessment, so this is quite some time ago, to be materially non-compliant in certain areas, basically showing that, of course, with all the international standards and the application across countries, there always needs to be an assessment of how material also the deviations from the framework are. We have done, and the European Banking Authority has done, an assessment of the impact of the new Basel rules on the European banks, and also whether there are potential unintended side effects. And what all these impact assessments show is that there's actually no negative material side effects in terms of reduced lending or reduced growth, and actually also the impact in terms of capital on the European banks is not very big, also because of the long phase-in and because banks can adjust to mitigate the impact. So overall, but maybe you may say I'm a little bit biased because I'm the chair of the supervisory board, I think this European approach has served us very well. Just if you look at how the European banks have weathered recent storms, the COVID pandemic, the increase in energy prices, they have remained resilient throughout because of the work that we have done in terms of capital and liquidity requirements, but also because there was quite a bit of fiscal support also for the real economy. So let me give you a few numbers to substantiate this a little bit, the resilience of the European banks. So when you look at the past 20 years, so going back until time right before the financial crisis, 2006, we've seen an increase in capital ratios, the CET1 ratios, from roughly 8% to 16%. Also, of course, the quality of capital has increased. So this is quite a big increase. For the leverage ratio, so the unweighted capital ratio, we have a shorter time series, but there also we see an increase from about 5% 10 years ago to now close to 6%. And of course, the banks hold comfortable buffers over and above the required capital ratios. Liquidity conditions remain quite favorable, so there's been a relatively smooth transition out of the period of quantitative easing, low interest rates to higher interest rates. Banks have good access to retail and wholesale funding, but we also, of course, monitor very carefully that they're prepared also for potential environment with tighter liquidity conditions. Quality of banks' assets remains relatively strong. A clear decline in non-performing loans from about 7.5% when we started the banking union to now 1.9%. But of course, we monitor very closely the areas where there might be a weakening of credit quality. Also, of course, due to the slowdown of growth that we might see, also related to the tariffs. Bank profitability clearly increased from the period of low interest rates, from that was a number of around 5.5%, almost doubled to close to 10%. Of course, this is also driven to a large extent by higher interest rates. But we must also say that the cost-to-income ratios have improved, going down from about 66% 4 years ago to 55%. So there's also been an improvement there. It's not just the interest rate effect. But of course, as supervisors, we always have to remain vigilant. And there's certainly headwinds that banks are facing, which may affect their profitability in terms of net interest income likely having peaked, a potential deterioration in asset quality, margin compression, and also loan volumes grow less fast. And this is, of course, not just driven by domestic factors, but also by the international environment. So how are we responding to these headwinds that the banks are facing? We basically, and this is just about the European supervision, we have three main priorities. One is geopolitical risk and the heightened uncertainty. So we had a framework that we published last year, how we deal with geopolitical risk. And let me make very, very clear, this is not a new risk category that we invented, but basically geopolitical risk is affecting the banks through the traditional risk categories. So we have this framework, and then we looked at the supervisory activities that we're doing to check whether we are addressing this. And let me just give you a few examples. Of course, it's good governance mechanisms in the banks that are needed, so that the banks look at adverse scenarios, that they do scenario planning, that they make sure that their provisioning practices are not just based on historical data, which may not give them a good view of forward-looking risks. And as I've mentioned, the EU-wide stress test has also been motivated by a geopolitical risk scenario. Second priority, and I mentioned this, is remediation. So we've certainly made progress in identifying weaknesses in the banks, but often the remediation is not sufficiently fast. So one example is the information infrastructures that the banks have internally. So this is about risk data aggregation and reporting. So we often find that banks don't have information systems internally that also provide sufficiently detailed information for the internal decision making. And so we follow up in case we have findings where we find these risk data and aggregation systems to be insufficient. A third priority, digitalization, very clearly, because the competitive environment there for the banks has changed quite significantly. There's lots of opportunities in terms of cost reduction, greater efficiency, building scale, but there's also new risks, as I mentioned earlier, related to cyber resilience, outsourcing. So we've done a cyber resilience stress test last year, and we also strengthened our oversight of outsourcing agreements. So these are things we do, let's say, internally in Europe within the SSM, but we of course operate in a global environment where we also depend on global standards, on coordination, supervisory coordination, and the European banks, as many banks globally, are really integrated into a global financial system. And as we all know, that risks that are exposed can cascade swiftly through the system, and we all know that many times in history we thought this time is different, and then often it's not different. So financial crises keep reoccurring, driven by high leverage and painful market corrections to overvaluation. So this is, I think, why together we have to be very vigilant to make sure that the banks are, to stay in the sailing analogy, have sufficient ballast to withstand sudden shifts in economic conditions, that they navigate with sufficient distance to avoid collisions, and that they don't sail too close to the wind, take on excessive risks, following short-term gains, and then only to find themselves being unable to stay afloat when conditions suddenly change. Unfortunately, we have a framework globally for dealing with these issues. As I mentioned, the Basel framework, I think, is very important to make sure that we have cross-border cooperation, the same standards, fostering trust, reducing the probability of crisis. And this is why, just as we work on financial stability in Europe, why we also very supportive of the work programs of the Basel Committee, the Financial Stability Board. These are exactly the fora that we need to provide financial stability as a global public good. Now, talking about global public good seems very abstract, but I think actually the benefits of having this are there for the citizens who entrust their savings to banks, the taxpayers who would otherwise have to pick up the bill in case anything goes wrong, and also the banking industry, because similar standards across countries, trusting counterparts, and also the absence of financial crisis, which means that losses have to be borne by equity holders, debt holders. I think this is in the interest of the industry itself, and not just of the globally active banks. Actually, in Europe, we have many banks that are regionally active that don't have that many international activities, but they all depend on trust in the banking system, in the financial system. So I think the benefits of global coordination span across all business models. And this is basically the key message that I want to bring here, that these common standards are not there to constrain activity, but to enable activity. We're coming out of a period of relative financial stability based on the common standards, the cooperation that we have achieved. We had a bit of a risk right now that the memories of the past crisis are fading, so we need to make sure that we don't prioritize short-term profits growth over longer-term resilience, but with that we retain the resilience standards, and we are certainly very committed to this cooperative approach. Then, because the best safeguard against accident at sea is to have sufficient water under the keel and not to sail too close to the wind. Thank you very much, and I look forward to the discussion now on the panel.
Thank you very much, Claudia Buch, for quite a comprehensive and clear summary of the challenges that we face these days. So I'm joined on the stage by two people who have a lot of perspective on this. Michael Silva has one of those resumes that you wonder, like, how could you fit all this into one lifetime? He was a lieutenant in the U.S. Navy. He spent 20 years at the New York Fed, where he was a lawyer. He was dispatched to help the Central Bank of Iraq after the invasion. He was chief of staff for two presidents of the New York Fed, Tim Geithner and Bill Dudley. And then for his sins, he was in charge of supervision of Goldman Sachs when Goldman Sachs became a thing. So that wasn't enough, so he went to work at GE Capital. He was a lawyer at DLA Piper. Then he was head of compliance, U.S. compliance for UBS. And now he's the lead director of an unusual bank called Column, which is a nationally chartered bank that is founded by a software guy and which does a lot of work with fintechs. So he's got the whole private sector, public sector perspective. Nicholas Varone is a senior fellow at the Peterson Institute for International Economics across the street, and one of the founders of Bruegel, a think tank in Brookings, in Brussels, rather. Sorry about that, that he helped co-found. Nicolas is a French citizen, and he studied math and physics. And I learned today that he went to a Polytechnique in Paris, which was a forerunner of West Point. So although he didn't sit in the backseat of F-14s like Mike Silva, he did sit in the backseat of tanks for a year. Apparently that convinced him that he should go into think tanks and studying bank regulation. Nicola is a very well-known commentator and analyst of bank regulation and banking issues. He's been an advisor to the French Labor Ministry. He's financial officer of a publicly listed internet country. He was, for a while, a board member of the Depository Trust and Clearing Corporation. So we have people who really know a lot more about what Claudia Buch is talking about than I do, which is why I invited them. Mike, I wonder, Claudia Buch made, I think, a very strong point that international cooperation among bank regulators and supervisors is good for everybody. And you've had a lot of experience in that world, and I wonder if you could talk about how you think about that and whether that's at risk given the current approach that the America First administration is taking here.
Well, thank you, David. First of all, I couldn't agree more. And my career has given me three particular perspectives on that I feel very passionate about. First, as David mentioned, I was chief of staff for Tim Geithner during the financial crisis. And during a crisis, and we will, as long as we have a financial system, we will have financial crisis. There is absolutely no substitute for being able to pick up the phone at 3 in the morning and talk to your international partners all around the world, speak a common metric, be talking about institutions that are on more or less a level playing field. And if Tim hadn't been able to do that, and Chairman Bernanke and Secretary Paulson hadn't been able to do that, we would have been in a very difficult situation. And it takes a lot of working together and a lot of trust to develop those kind of relationships. So we will be at 3 a.m. in the morning again, another financial crisis. Second thing that during my own career that particularly relevant is there are some risks that you just absolutely can only be assessed on a global basis. They cross borders. We're looking at one right now. AI has tremendous potential, right? But there's also immensely important safeguards and potential risks. And some coordination and standard setting for that very, very important technology that's coming forth is critical. And then cybersecurity is another one. Personally, I think there's a very good chance the next crisis comes out of some sort of cyber event. And there in particular, the system is only as strong as the weakest link. and coordination with our international partners would be absolutely critical. And then finally, very simply, without international coordination, what you have is a race to the bottom, right? I mean, I think that's just a very a basic thing. Do I think this is going to change? I think not substantially is my hope. Yes, there's been a change in administration, but not a change in certain concrete realities in terms of managing risk, dealing with crisis, trying to promote a level playing field in the financial system. So I think there's going to be certain, as I say, sort of laws of gravity that continue to compel this very important international cooperation.
So Nicola, how do you see the state of international banking coordination on supervision, the fate of Basel III, which the U.S. seems to have decided is too hot to handle for a while?
First, thanks.
It's in the bottom of the tank.
Yeah, exactly.
There we go.
Nicola told me that he learned after a year of military service that he wasn't good at that. So he's demonstrating that.
Exactly. Well, it works.
Problem solving.
Yeah, but when it doesn't work the first time in a military context, sometimes it's a problem. Well, thanks for your kind introduction. Just for the sake of clarity, you mentioned DTCC at the end. I haven't been a board member of DTCC. I still am a board member of their trade repository arm, which is a more limited piece of plumbing, important but limited. But it doesn't create, in my opinion, any conflict in what I'm going to talk about today. Well, there's a risk that there might be a little bit too much agreement on this panel, including on the question you asked to me, David, international cooperation and the Basel framework. For the reasons that have already been mentioned, the Basel framework is essential. It's a very important public good. It has been there for more than 50 years. There have been ups and downs, but if it wasn't there, we would need to invent it, basically. So this is, as you know, the Basel Committee is a committee on banking supervision. Its primary purpose is to have coordination on supervisory practices. It was born from the Herstatt crisis in 1974, and it is very important, as was just emphasized, and I completely agree, that supervisors know each other, that they have a common playbook, and that they have a common language. Now, the Basel Committee, as you referred to, has also been famous or notorious, depending on the point of view, for its regulatory standards. So these are non-binding standards, of course, because they are set at a global level, but there is a strong recommendation to individual jurisdictions to transpose them in their own rule book, which has been by and large the case for the jurisdictions that are members of the committee. And right now we have Basel III, which was created in different phases between 2010 and 2017. And Basel III is still not implemented in a comprehensive way. So there's a very long lag since the final agreement was reached in 2017. And that long lag is, to a certain extent, attributable to the US reluctance, the politicization of this agreement in the US context, which has been, in a way, encouraged by the banking community. Maybe we'll come back to that. Now, I will actually be reasonably optimistic in terms of the resilience of the Basel framework. I think the very large American banks, most of them, maybe not all of them, but most of them, the G-SIBs, as we say in the banking jargon, the globally significant institute.
Globally significant.
Yeah, international banks.
Banks.
Something. We all forget.
Systemically important. Globally systemically
exactly.
important.
Well, the problem is that there are two adverbs, right? It's globally and systemically, and it makes it very confusing. Anyway.
Probably worse in German, but.
Yeah. So the US G-SIBs, from what I gather, are not hostile to Basel III implementation, including the one piece of the Basel III Accord which is most impactful in terms of global competition on globally integrated segments of the banking space, which is the fundamental review of the trading book, the FRTB. Maybe we'll reuse that acronym. So right now, the EU and the UK have suspended their implementation of the FRTB because the US is not implementing it. The EU has implemented the rest of the agreement by and large with the variations that Claudia alluded to. The UK has delayed it. The reason why US G-SIBs, the JP Morgans and Wells Fargo of this world, why they're actually favorable in my understanding, but things may be a bit more complicated, to the implementation of Basel III, is that there's something that could be even worse for them, which is fragmentation of the regulatory framework. And that means global fragmentation with different rules in different jurisdictions for global banks like JP Morgan or Citi, or those which now are banks like Goldman Sachs or Morgan Stanley or Custodian, State Street, Bank of New York, which address a global market. But also the prospect of fragmentation in the US. Because in the US you have this complicated system where you have state banks, national banks, you have a lot of state regulators, and it's pretty clear that if the federal level doesn't do its job of regulating banks, some states, not all of them, will take that into their own hands. And that's not good for the banking industry. So I think it's going to be very interesting, and I'll stop there for the moment, to observe the behavior of the Fed and other federal regulators, but also to look at state regulators in the current environment where Secretary Bessent has said in no uncertain terms that he wanted deregulation of the banking sector in the US. And to see how the dynamic between the risk of fragmentation, both inside the US and internationally, will be managed by the US political system, including the lobbying by banks, with a trade-off versus what banks always do want, which is reduction of capital requirements.
Do you worry, Claudia, about fragmentation of the global regulatory and supervisory?
Well, I mean, this is what I was saying. I think I agree with what has been said, and I also said it in my speech that actually having global standards is in the benefit of the industry, no? Because it's benefiting the larger institutions that are active globally, but it's also benefiting the smaller institutions that would also be at risk if anything goes wrong. No? So in that sense, I would agree. I mean, I'm more on the optimistic side that we get an agreement, and that also we have international implementation of Basel. One must say I mentioned Europe, but many other countries globally have also implemented the Basel standards already. No? So in that sense, I tend to be optimistic.
But I guess the question is there a political consensus for this?
Well, I can't judge on what's happening in this country, so there's people on the panel who know much better than I do, and it remains to be seen. So, but I think Nicolas said something very interesting also about the fragmentation within currency union, the US, you mentioned the potential risk that there's more fragmentation. And in Europe, we clearly have a big discussion. We have a single supervisor, we have a single rule book when it comes to prudential regulation, but we have many national rules that are affecting banks which are not harmonized. So actually the discussion in Europe is a little bit the opposite right now. How can we go to a better integrated single market? How can we make sure that we also use the current situation a little bit as a stimulus to promote integration in Europe? And this is certainly something we would advocate for. So it was running under the heading of the Capital Markets Union, Banking Union project. Now this has been combined under the umbrella Savings and Investment Union. But this could be a great opportunity for Europe also to harmonize rules that are currently different across countries. Again, not the banking rules, but other rules that are relevant. And so then lead to more integration, less fragmentation in Europe. I think that would be important.
One of the lessons of the Silicon Valley Bank crisis in the US was that supervisors and analysts hadn't paid as much attention as they should have to concentration risk among depositors and interest rate risk. And I wondered how that's affected, if it has at all, your approach to supervision in Europe.
No, I mean, this was clearly something, I mean, the findings from the 2023 turmoil, SVB, Credit Suisse, so this was, I think it was also, I'm very grateful to all the supervisors and regulators who wrote reports, and so that the rest of the world could learn from these episodes. This is clearly something we looked at very, very carefully. For us, it was also a little bit, it came a bit in parallel to the big reform that we initiated already in 2023 of our supervision, how we want to conduct supervision to become more effective, more efficient, to make sure there's remediation. So this was clearly, I think, from a supervisory perspective, maybe an episode we all collectively would have liked to avoid, but something which helped us looking into this specifically when it comes to liquidity. We do a very, very careful liquidity monitoring for the banks. We introduced in the fall of 2023 a weekly liquidity monitoring so that we have continuously good information about the liquidity situation of banks. And of course, we look very carefully at the indicators that were found to be difficult for SVB. But this was a very specific case, but we clearly took the lessons from it.
Mike, you mentioned, as Claudia Buch did, the cyber risk. I wonder if you could expand on that. What do you mean by cyber risk? What specifically? And what do you think, how well equipped is the banking industry in general to protect against it?
Well, in the first instance, and the most worrisome instance, cybersecurity refers to the possibility of a bad actor. They could range from anybody sitting in a basement in Eastern Europe to a state actor getting into the banking system and causing immense chaos, and without too much difficulty. Shutting down clearing systems or denying access to accounts. And particularly with the introduction of AI, which the bad guys have as much access to as we do, this risk is only going to escalate. And you know, as we've mentioned before, currently it's a very heightened geopolitical tensions. And we know there are state actors that have cyber tools as part of their toolkit. I also mean, when I say cybersecurity, and this is probably not the most accurate use of the term, but I also refer to the chance of an internal cyber mishap. I'm immensely concerned, having now been associated with a purpose-built, cutting-edge core banking system and seeing what advanced technology can do in terms of risk management, in terms of resilience, in terms of scalability, flexibility, and especially in terms of cybersecurity. I'm very aware of what an immense IT deficit many of the large banks have. They've underinvested for decades in their core systems, and those systems are vulnerable. So I do worry quite a bit about that.
Nicola, how much should we worry about non-bank financial institutions? I understand it's not the remit of you got plenty to do on banks, but I'm curious whether you think we're focusing too much on the banks and not enough on all the non-bank financial institutions.
I actually tend to see it the other way around.
Interesting.
I think there's a good reason we focus on the banks, because the banks create money. We have deposits in the banks. And time and again, we've seen the banking industry distracting the conversation away from themselves and pointing to NBFI, non-bank financial institutions, I got that acronym right, to say, hey, here's where you should look at for risk. Silicon Valley Bank, you mentioned Silicon Valley Bank. Let's spend one more minute maybe on that. It was a very powerful reminder that there's something about banks. And if you don't focus your attention very obsessively on the banking sector, you're going to have bad experiences. Claudia was very diplomatic in the way she answered your question. I can afford to be a bit less diplomatic. The Fed, the supervisors in the US didn't have their eye on the ball. The European, and for that matter also British supervisors did. In 2021, a year and a half before the incident, the ECB banking supervision, at the time it was led by Andrea Enria, listed its supervisory priorities, and they said business model risk, interest rate risk, front and center. The Fed didn't do that. So I think it's always a bit difficult in Washington, D.C. to say maybe the U.S. system could learn from experiences outside of the U.S. I don't even dare call them foreign. But it is the case that in this episode, the U.S. supervisory system was not the global best practice, demonstrably. The Silicon Valley Bank incident happened with a very parallel trajectory of interest rates and interest rate shock and inflation shock between the US and the Eurozone, and again, the UK for that matter, and other jurisdictions. And basically, the US failed the test. The European banking supervision, despite it being so young, passed the test. And I think there's a lot of thinking to be had from them, but also, frankly, of the great financial crisis in 2007, 8, 9, when it was the exact same thing. You went to a financial stability conference in, say, 2006, 2007. That's about the time when I started to be in this business. Everybody was talking about hedge funds and private equities. This is where the next financial crisis will come from. Well, it was banks, or things that should have been regulated as banks, like Lehman Brothers, Fannie Mae, AIG financial products, and the like. And Washington Mutual. We shouldn't forget that banks are at the core of financial stability, and NBFIs are important, of course. I don't want to say don't look at NBFIs, but they're essentially, from a financial stability perspective, leaving aside insurance and pension funds, that's a separate discussion. But for the rest, they're important only to the extent they affect banks. If you think of Archegos could, lose all their money, but the banks which had exposure to Archegos, that was a systemic risk. So that's what we shouldn't forget.
So do you want to contradict Nicola's praise of the European supervisors?
How could I? No, of course I wouldn't contradict him like that. So, but one nuance when it comes to non-bank financial intermediation and the links of the banks, I fully agree that we should, and this is why I cited the numbers also on the importance of global banking assets, and clearly for the European economy that the banks are core, so this is why we need to make sure they remain resilient. But they're linked to the non-bank financial intermediation sector, and they sometimes themselves have relatively limited visibility as to what exactly these links are, where vulnerabilities building up in that space. So I think we do need a bit more reporting also, and more transparency as to what is happening in the non-bank financial intermediation sector for the risk management of the bank and also the banks and the supervision. And there's also there can be sources of systemic risk in the NBFI sector, and we may also need tools for that to address that type of systemic risk. So I think this is really, this is where our ability is limited to address this risk, because we look at the banks, but there can be sources of risk building up, and they need to be addressed in the proper place. I don't know if can I come back very briefly on the cyber resilience point, because I think this is really critically important. So as important as we think that financial resilience is capital and liquidity, this is core, and as I said, this is core to our supervision, but we also think this operational resilience part is really critical, and the banks need to invest into their IT systems, their IT infrastructure to have a sufficient degree of cyber resilience. So we did a cyber resilience stress test last year. This was about a hypothetical scenario. What if a cyber attack is successful? How well are the banks prepared? Do they have recovery mechanisms in place? Can they assess the cost of such a cyber attack? And I think that was very useful for us as supervisors, but also for the banks. So we through the SSM, we give them the opportunity to learn from best practices of others. So this was really one of the exercises that was also appreciated, I would say, by the industry. And the reason being that we've seen a doubling in the number of cyber attacks between 2022 and the current numbers, and also the severity of the attacks has increased. And this is clearly also what the CROs are mentioning in the survey that I mentioned.
Mike, how much do you think about digitalization and how it could change the banking system and the need for supervision? I'm thinking about stablecoins, the digital euro, all the things that the fintechs are doing that we couldn't even imagine 10 years ago. How big a challenge is that? I mean, it's obviously an opportunity, but how big a challenge, and do you think we're managing it well?
Digitalization, tokenization, AI, there is a tsunami of IT-related innovation that I think is just going to engulf the banks much more quickly and the regulators than we expect. As much as we're talking about it, I see it happening even faster. And I don't right now believe that the regulators have the right tools to monitor these risks. And that might be in part because I have been exposed to a very modern platform, and the abilities of AI, if the regulators start investing now, and the largest banks too as well, the ability to build up the capability for systems for real-time monitoring of liquidity risk, of capital levels, of market manipulation is possible. I've seen it, and I think it could be very useful and very important with respect to stable coin.
Thanks. Claudia, I want to ask you one question before I turn to the audience for some questions. How much do you think about climate as a concern of supervisors?
Well, it's one of our priorities, has been for some time, in the following sense, and let me make this very clear. So we are not climate policy makers, we are policy takers. So whatever climate policy decisions are being taken, that can have implications for the risks of the bank. So we look at it entirely through a prudential and supervisory lens, but there's transition risk, there's physical risk that are very relevant. And we started working with the banks around 2020, a little bit earlier, and trying to see whether banks have frameworks in place to manage climate and environmental related risk. And at the time, there was relatively little. So we did also stress test, the banks did their own assessments. And then we had formulated supervisory expectations of how we think the banks should address these risks. And a lot of progress has been made in the meantime, one must say. So most of the banks we supervise have frameworks in place, consider the topic to be important. And of course, I mean, as usual, as a supervisor, if you find deficiencies, you also follow up upon those deficiencies. But it's clearly an important, like the geopolitical risk, it's a risk driver. It's not a novel risk that we've invented, but it can affect all risk categories that banks are exposed to. So this is why they need frameworks, governance frameworks, information infrastructures in place to deal with these risks.
Thanks. So I'm going to take some questions. We have mics. I'm going to suggest that there's 3 hands. I'm going to take all 3 questions, and maybe we'll take a fourth afterwards. You want to start over there? Please stand up. Tell us who you are, and remember the questions end with a question mark.
Hi, so my name's Ujjwala Palluri, and my question is, given the Basel Committee's increasing focus on proportionality, do you see room for a standardized Basel-like framework that enables credit unions, cooperatives, and SME-focused banks to scale lending while still maintaining resilience? What would be the key challenges and opportunities in implementing that globally or even regionally?
Great, thanks. I'm going to pass it to in front there. There was someone. Tell us who you are, please.
My name is Kara Allen. Just to follow up on the digitalization conversation, you mentioned kind of introducing real-time AI, but I think another issue is having people on the supervision side who have that expertise to accurately understand the risks. And if you don't necessarily have that on the bank side, I guess my question is 2-part. 1, how do you deal with that disparity? And 2, in terms of focusing on those skills, what are you planning on the ECB side? Is it going to be increased training, increased hiring, consulting, that kind of thing? Thanks.
Thanks. You want to take the 2 over here?
Whoops. Hello, my name is Hugo Doyle. My question refers to the frameworks that you require for dealing with geopolitical risks. You mentioned last year that not only should frameworks be required to tackle the Rumsfeld categories of known unknowns, but you mentioned also frameworks to deal with unknown unknowns. How do you expect this kind of complicated act?
Those 3 meaty questions. I'm going to let you. I don't. This proportionality credit union cooperative thing. Do you know what? Does that
Ring a bell?
Yeah. Do you know
Well, I can say something. Thanks for the question on what we do in Europe in terms of proportionality. So proportionality is really key to everything what we do. So it's about, from a substance perspective, so what we do needs to be proportionate to the underlying risk, also that can be related to the size of the institution. So it's also actually a legal concept that we need to be proportionate in what we do. So sometimes it's confused with the size of the institution, but it's actually covering the whole spectrum of our activities. And I think it would be too complicated now to go into the details of all the institutions that were mentioned and how it's related to the Basel framework. But this is a very clear message that whatever supervision we do, it needs to be proportionate in a legal sense and also proportionate to the risk. Yeah.
And dealing with skills of supervisors on digitalization and
Can also take
yeah,
that. Yes,
no,
yes,
I'm going to let you take all three, and then
okay.
those guys want to weigh in, they can. If not, we'll try another question.
No, I mean, thanks for the question, because that's obviously key for us, that we need our supervisors need to have the up-to-date skill set at any point in time, and digitalization is really a key challenge here. And also, yeah, and I would say we have at least a twofold approach. One is clearly training. So we have a lot of training programs. We do a lot of work on AI to make sure that the supervisors are sufficiently skilled and up to date. And of course, we would also draw on expertise from outside of the organization to get that skills, but we need also the skill set inside the organization. That is very clear. And the second is it's a bit, I don't know whether I should call it learn it by doing or also using the tools ourselves. So we have a big subtech agenda. So we're using AI, IT tools also to improve our own supervision, to be faster, to be more effective. We have an large language model that is fed by our internal documents. So I think this is the best way to actually, not just theoretically do training, but also apply these tools. And we see a lot of benefits coming out of it. So we can be much faster. We can process information much faster. And then, again, in the spirit of proportionality, really focus on the things that are relevant. Yeah.
And then the third question, I had this. So when you think about geopolitical risk, we all understand what's going on. Well, I shouldn't say we understand. We all see what's going on with tariffs and all that. But I think geopolitical risks are bigger than that. How do you even begin to think about doing stress tests or making sure the banks are equipped for things that we can't even quite imagine what they are? The known risks are bad enough.
I know. Well, we thought it would be useful to kind of, first of all, start from the traditional risk categories of banks. And we mentioned a few of them: credit risk, market risk, liquidity risk, and then see how geopolitical events, geopolitical risk could impact on these risk categories. And so we looked at the financial markets channel, which is typically the fastest, that all of a sudden there's a repricing of risk, there's market stress. How does that affect the risk categories? But it's also the real economy channel, the trade channel that I mentioned. That's also kind of a motivation of the EBA stress test scenario. And then, of course, there's operational risk of the type that we've just been discussing. So there's a paper we issued last year, which is kind of doing the mapping, basically. And then we went through it and we said, okay, so are we addressing these things? And we found, for example, for cyber risk that we have the stress test, we have work ongoing, and do we see any gaps between what needs to be done and what we are doing? And we found that we're covering most of these transmission channels. But then, of course, there's work also that the banks need to do too. And for example, with the known unknowns, the unknown unknowns, you need scenario planning, and it also needs to have tone from the top, so the senior management and the boards have to be involved in this and also make sure that there's sufficient response to the high uncertainties that are there, and to make sure that the banks have robust strategies to deal with that. So that's basically how we are.
Thanks. Let me take one other question. I'll get back to you guys. The gentleman in the back.
Hi, I'm Karthik Shankar. Just following up from the last one, I have a couple of alarming things potentially geopolitically. One of the issues in the European banking system is that the banks are vastly more internationalized than the currency is, which makes European banks critical intermediaries in global dollar finance. And at a time when you have somewhat more difficult geopolitical relationships across the Atlantic, I had questions about three different aspects to this. One is sanctions risk, potentially an expansion of the pace of sanctions. We saw this already with BNP in 2014. Secondly, there is periodic loose talk. I think it's only loose talk about swap lines and the weaponization of swap lines. I hope it's loose talk. And the third thing here is a real emphasis in this administration not to do a CBDC, but to do stable coins, which then potentially creates financial stability risks, maybe in the US, but certainly outside, by permitting easy currency substitution and so on.
So why don't I let Nicola, Mike, and then Claudia respond. A lot of meat there.
Yeah, too much.
You can take one slice.
Too much to address, really. I will just add to the complexity of the pictures that Kartik just painted by saying that in European perceptions, in European reality, since the sequence in February from the Van speech in Munich to the notorious Oval Office situation with President Zelensky, at this point, geopolitical risk includes the US. We cannot be in a situation in Europe where the fight of Ukraine to defend itself is existential, not just for Ukraine, but for Europe. There's a US administration that appears to favor the other side. So that's the situation we have, and it has direct translation into the banking space. It's very unfortunate, maybe, but that's the current situation. Let me stop here.
I would just comment from a U.S. perspective that I agree. We're adding to the risk right now, but I'm very optimistic that there are certain laws of gravity with regard to the markets, with regard to the realities of what it takes to end a war. And with regard to the importance of our global alliances, certain realities that are going to eventually moderate behavior. We'll see. Your stablecoin point is very relevant. I would be worried about it if I was outside of the U.S. I think it does pose some great potential for the U.S. In terms of its reserve currency, but some real possible stability questions outside of the U.S.
So if I can boil down Kartik's question, I think it was the dollar is very important to the European financial system, to payments, to the swap lines when there's a demand for dollars, which doesn't seem to be so great right now. How do you think about that as a supervisor, your vulnerability, the fact that the dollar is such a big part of the European financial system?
Well, I mean, I said it a little bit before. So clearly, what we do is we do a very careful monitoring of liquidity. This is business as usual. Now, this is always how we do supervision. And of course, also we look at FX funding. So this is kind of where we currently are, so that we're monitoring this very closely. When you look at the response of the market and also the banking sector to the recent revaluation on markets, I think we haven't seen any significant event or liquidity shortages. So I tend to believe this is also due to the fact that we monitor this very carefully and that we make sure the banks have good funding plans there. So, but I mean, my response to the question would also be that it's actually what we're seeing is also a reason why we also need to strengthen the European framework. And I mentioned the single market and what needs to be done there. And we also have and Nicola, most importantly here on the panel, knows this. We have some things on our to-do list for Europe also when it comes to the crisis management framework, when it comes to European deposit insurance. So there's also still a whole package of things that we have to do in Europe. The digital euro, I think, will also be an important response to generally these global developments that we're seeing with regard to digitalization of finance. So I think we just need to do our homework and stay vigilant. It's not an easy environment in which we live.
Well, Claudia Buch, I want to thank you very much for spending time with us, and Michael and Nicola for your comments, and also for such good questions from the audience.